Be strong.
Hi everyone, welcome to another FinPlus video. Today I'm going to give an introduction about the stock market. When I was 9 years of age, this was probably around the year 2012, I grew up watching a lot of TV, and some of the movies that I remember watching were like The Firm, right, starring Tom Cruise, and I was also watching lots of documentaries because that was the time of the housing crisis. And I came across a lot of financial terms like Wall Street and stock trading, right? And I also figured out that there's a lot of money to be made in these industries. And the word that was associated with this money was stocks. And this sounded really cool to me. It sounded rich. So then I did some more digging and figured out that all of this was connected to something called stock market. And I also found out that it was a form of investment, a way in which I can make higher returns over a period of time. And I realized it was a get rich quick scheme. Sounds cool. So now let me explain what it is. So as always, I'd like to start with a definition because that makes things easier. And the definition of a stock market is it's a marketplace where buyers and sellers convene to purchase shares of different companies to make higher returns, right, off that initial investment. It also helps companies raise capital, right? Capital in the form of money, financing basically. Now, shares to make higher returns in companies raise capital. These three things really stand out. But how do these things really happen? We don't know that yet, right? So let's start off with the basic question. What are shares? To show this, let's take an example of an arbitrary company called Company A. And Company A comprises of 100% ownership. This could be owned by anybody, but it's 100%. So then a share is literally just a part of that 100%. It represents some ownership, but it's very minute. And we can show this ownership by shading it, in orange, and that's your share. Again, this is a very, very small piece of ownership, and this can be about 0.0000001%. It can become very, very small. But each share also has a value. If a company has a value, if 100% of a company has a value of $1 million, and obviously a very small part of that company will also have some value. Like one share could be $1, or one share could also be $100, or for all you know, one share could be $100,000. It really depends on the company we're talking about in terms of its size, its product, and its reach. So, but when we get back to that question, right, how do these things happen? How do companies raise capital? So let's take another example. Say I purchase one share of Company A at $1. Now, this action simply allows Company A to raise $1 of revenue. When I purchase a share of Company A, I'm giving them $1. And I can purchase multiple shares as well. So now, so Company A will get $1 richer. And you can sort of represent it like that. And maybe company will use this $1 for development, maybe improving their products, maybe paying their workers a little more, and for all you know, they could just buy a chocolate for all of its workers, keep them happy and productive. But in essence, Company A is raising capital, not only from me but also from a lot of other people, and then they can reinvest this capital in their company, and this is how I can gain from it as well. So when a company gets larger by reinvesting their capital with maybe their workforce or their products, they might actually incur higher profits. And this might be because of lower costs. Maybe they improve the marketing division, right? So overall, the company is growing now because they're raising more and more money from the stock market and they're improving. And eventually, since company A is doing well, they'll probably need more capital to sustain that growth. And the way that they can actually earn more capital is from the stock market itself. They might actually raise their share price from $1 through to about $3. And if you look at this closely, right, I mean, obviously their stock value has increased. It's increased from $1 to $3. And we also use the terminology that the stock has appreciated. And now we can actually talk about how this has benefited me. We've already talked about how a company can raise capital, but how does it benefit the investor? So if you look at my example, I bought one share for $1, but now since it's $3, I could actually decide to sell my share and make a $2 profit on that share. And if I have multiple shares, I can make $2 profit on all of them. Now, if we do a quick recap, today we learned that companies can use the stock market to grow, to raise capital and to reinvest in their business, hence appreciating the value of their stock. Similarly, because of that appreciation, investors can also use the stock market to make high returns over time. But one thing we didn't talk about today was, how can we actually judge the performance of a stock? Are there different ways to analyze the performance of a stock? So this is something that we're going to talk about in the next video. And although the stock market might appear risky, we also have something called mutual funds, which seriously mitigates that risk. Thank you for watching.